Welcome to the Dividend Talk podcast, episode 45, quarter two earnings 2021. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with European DGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you're new to this channel, please hit the like button and subscribe to us. And check out our previous episodes on YouTube and Spotify. See you on the inside. Hey European DJI. It's good to be back on a Friday night.
Yes, definitely. I must confess, I'm a little bit tired. Long week of work behind me, but also we had dividend day yesterday, and I think what was it? I think I switched off almost at 2 a.m. 2 a.m. So I slept probably 4 or 5 hours. So I'm a bit, I was a bit slow today, but totally pumped up for this episode again.
Yeah, last night was great. We usually have dividend day around Intel's earnings. It's become a little bit of a tradition, and funnily enough, we did not discuss their earnings last night. But there was what 12 of us on there, which was amazing, and there was some knowledge. To be fair, wasn't there dropped, so it was super fun and glad to meet some new faces and always some old faces as well.
Yeah, definitely. So I'm also really excited for today's show because we had Ian Lapuk, of course, the last two shows. But earnings seasons have started again. There's always these weeks that I'm always looking forward for the first full week of earnings because we can see our portfolio is doing in the sense of our hypothesis is confirmed regarding the companies that we have. Are the catalysts still at play? And of course, the annual earnings are of much bigger importance for me personally, but the quarterly earnings are rather for the confirmation, like, are they doing the right things or not? Probably also good to mention, I mean, I don't know how it's for you, but when I'm working and I'm working 3 months in my company, it's not like in 3 months we can turn a whole ship around in a company, right? So that's why I look a little bit more at the trends here a little bit, but don't take it, I said.
Yeah, don't make any decisions based on them. But hey, before we get into that, let's talk football because I mean I've seen your tweet on Twitter. I haven't been too active, and you're a huge supporter of this Super League, and
Yes.
honestly, I think it's such a I won't use a harsh word, but I just think it's such a crazy idea.
And why is that for you?
Because you have whatever 12, 15 founding clubs that do not have to do anything to gain entry into this competition. I mean, it makes no sense. What's the incentive? And you look at these big clubs. I don't want to talk bad of a club, but I look at a club like Tottenham Hotspur, or Spurs as we call them. I mean, how are they classed as a big club? I can't even remember the last time they won a trophy. So how are they? And Arsenal the same, and even Liverpool. Liverpool won the league last year, but we don't deserve to be there. I just think it's greed, it's money, and for me, it would just ruin the game.
Okay, so you're telling me there's no greed and no money in the Premier League at the moment?
There is, but it is a little bit more spread out than what would happen if these 6 clubs from the Premier League go into a Super League.
So, yeah, for me, it's all hypocrisy. I mean, if I look at the UEFA and the FIFA, if there's one mafia gang and mafia family, it's those organizations. Yeah, they just are just power hungry. And then when I hear the noise from the Premier League with these old football stars, I mean, they cannot tell me that they enjoyed going to Swansea somewhere in the 90s to play there. I think it must be horrible, but it's like with having children. When you have children, you at the moment you hate almost your kids with all the fights you might have, right? But afterwards, you always look better at that period. So all these pundits that are talking about, I mean, I look at it different. Yeah, I live in Poland. It's horrible to watch Polish soccer.
Hmm.
If I watch Dutch soccer, I also can't watch it anymore. For me, the season really starts when the quarterfinals of the Champions League start to enjoy football, right?
Yeah,
And imagine that I could at least get this now every week a little bit. And why should they be straight away excluded from the national leagues? Keep them in there.
but look at the teams that have signed up to this. Right, you've got
Yeah.
Spurs, Arsenal, AC Milan. These are not clubs. These are clubs in decline. I mean,
But no, these are clubs that are great to watch at Tottenham Hotspur to Real Madrid. I like watching such a game. The stars are on the pitch there. Liverpool as well.
what about Ajax? You're a Dutchman.
Yeah,
What?
I would like Ajax to see in there. I am not an Ajax fan, but I believe Ajax deserves to be considered there, and
But
I'm sure that they there would be, and let there be a Super League level 2 or something like that. For me, the Champions League has been so boring. I'm waiting till what is it, February, March to start enjoying football matches there. And, for me, it's a great solution to have already great matches in September and October.
for me, the easy fix for this is to scrap the Champions League, or reform it where it is just champions. None of this crap where second, third, fourth place
Good, good,
teams go.
good. So,
Okay,
and what
just
is what?
champions.
And the Champions League is expanding. And what was the Champions League doing? It was all about money, all
Yes.
about money.
Yeah.
So, and then the I said the FIFA and the UEFA are blaming the Super League for being greedy about money. Ah, for fuck's sake, this is just pure hypocrisy. And the Premier League as well. They all want those billions. They're just jealous.
Of course they are, but the divide will just get bigger and bigger, and there'll be no competition left.
Well, at least I can watch it something. Yeah.
I should be happy as a Liverpool fan. At least we'd be guaranteed European
Yeah.
football, unlike this year. But I look, I think football is I think it's going too far. Players, managers, everyone's just money, 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 and
Yeah,
I,
it is. It is. I don't like that either. But if it is a fact, then I'd rather have a Super League. But I'm in a minority here. Probably 90% of the listeners think like, what an idiot I am. So, it's just my opinion about this. Anyway.
cool. Hey, look, we'll move on to more financial matters. I think you have something with Chubb, I believe.
Yeah, it's interesting, right? I own Chubb as an insurance company. I love this company. It's a really nice dividend grower, dividend aristocrat as well, and they wanted to purchase Hartford insurance. So it's insurance, business, home, and car insurance, right? And I thought it was a really nice portfolio fit for Chubb. But Hartford rejected the merger bid, which it was around 22 billion, and they don't agree with the terms. I believe that Chubb gave like 2-3 times another offer, 20-25% on top of the price it was going for at the time. But yeah, it got rejected, which is a pity because I thought it was a really, really great fit for Chubb, and I would have loved to see this merger. I find Chubb just an excellent company. And what I really loved in their statement, they said, although we are disappointed, we want to repeat that our shareholders demand of us and we demand of ourselves that we remain a disciplined acquirer. And this is what I love. Yeah, this management is so in control of what they are doing. Yeah, for me, it's an exemplary management for a great company. It's just a pity that it's already so high priced, but that's the thing, right? With well-run company, well-managed companies. So pity that it didn't go through.
Yeah, if you gotta admire the management, they had a price and they will not go above that. So, I mean, head off. It could be easy for them to keep pushing because, as you say, it could be a great fit, but you have to respect management on that
Yeah.
one.
Okay, shall we do some earnings then?
Yeah, let's do it.
Would you like to start with AT&T?
Yeah, of course, our famous buy the dip company below 30. I mean, looking at the figures, they seem like they had a good quarter. Revenues were up 2.7%. Adjusted earnings were up. More importantly for us, the free cash flow was also up. But then if you look a little bit deeper, you can see that their net ads, the mobile ads, postpaid and prepaid, was up over 800,000, I think. The revenues in that segment alone was up 9.4%, which is encouraging. The Warner Media segment revenue was up 9.8%. So for me, it looks good on paper. I didn't go deep into the financials, just looked at the headings, and it looked quite good. The key question for me is they have 1 quarter left. Will they raise that dividend? I did a little bit of math, and I think they will. I mean, they've called out and said that they want to sustain their dividend, but it'll be in the high 50s. At the current rate, it was 54%. A 1 cent increase will bring that up to 59%. So I think even if free cash flow stays flat, which we know it'll probably grow a little bit, I think it'll be safe to say that they will increase it by 1 cent next quarter.
Yeah. I hope so. I'm shareholder in the company,
Mhm.
and it would be good that they keep increasing. But honestly, if they would stay flat, I wouldn't be too bothered. It's like what European companies do a lot. So, we spoke a little bit this earlier about this. For me, it's really hard to analyze their data. If I compare, for instance, the quarterly one results with the annual reports, I need to recalculate things because the balance sheet looks different with different accruals and accounts. It's really hard. But what I started to really come to a conclusion to, if I want to track AT&T, I shouldn't look at their EPS because it's so much manufactured. There's so many adjustments. It's hard to follow, and the same is with the free cash flow. For instance, why the earnings are a bit higher now, the earning EPS, is because they had less depreciation and amortization of almost 1.5 billion this this quarter compared to last quarter. And this is mainly the reason why the numbers look different. So when you then start looking at the free cash flow and such, it becomes also quite complicated to compare. So what I started to come to the conclusion, for me, what I will compare going forward is the Ebitda numbers. And to my surprise, and here I need to give at least a little bit of credit to AT&T, they are reporting these numbers quite nicely in the statement. And from that point of view, their EBITDA declined. And I'm not looking at the adjusted EBITDA because, again, then they are putting some awkward adjustments in there. But just if you look plainly at the EBITDA, it went 1.3 billion lower, around 10% down. So, and for me, I think the EBITDA here is probably the most cleanest number for me personally to look at when evaluating this company. And so it went down. So, and it doesn't show really, like, it shows only the positive segments here. It doesn't really show the negative segments in their headlines. Yeah. And there's also, again, for me, a sign that I don't trust AT&T really in the numbers because it's hard to match, that they confuse us all the time. It's hard to trail the money flow. It's hard to trail the debt. They only call out mainly the positives. So these are for me all kind of amber flags that are telling me, like, are they like not cooking the books that would make them end up in jail, but are they trying to fool us a little bit? I think they're just in a really difficult position at the moment with such a high debt load. They're in such a difficult position to justify some of their actions that they don't have flexibility just as a company, right?
Yeah. We found that with Dividend Wave, we had a conversation, and there was a group of us try to match the debt numbers between the financial statements and the annual reports and the SEC filings, and we just could not get them to match. And there was 3 or 4 of us, and we're all trying to put the figures together, and it should not be that complicated to follow from one to the other. It should flow. So that's a good spot. Maybe the Ebitda metric is probably a nice one to follow with these. But I mean, free cash flow is hard to cook as well. I know they can, but that always seems to be clean. And for me, at least the dividend is safe for now. But I mean, that debt is still worrying. And if they are doing some financial trickery, it has to be a red flag. Has to be.
Yeah, true.
But hey, look, overall,
Overall, good numbers, I
yeah,
would say. Yeah.
good numbers, and enough for them to go above 30. So it might be time to sell and buy the dip when they go go back under.
Yeah. So let's talk about European stock because sales. As I said, Nestle had quite an upbeat report, I believe, right?
Yeah, yeah. So with European stocks, they don't usually give full earnings numbers. It's
They
normally
give sales numbers.
sales
Yeah.
numbers, and apart from half year, so it's hard to get a good read. But organic growth reached 7.7. Some of that was pricing of 1.2%, and then they have real internal growth. Most of it came from coffee, which was quite interesting. You have Nespresso, Nescafe, and the Starbucks products as well, which honestly I didn't know until this week, until I read that they actually own the rights to sell Starbucks in stores. Which I'm not a fan of Starbucks, but if you wanted exposure to them, this might be a good way. Spring water was down a little bit, and we can see that obviously with other companies, and they also the infant nutrition, and we'll see this with Danone later as well. That seems to be down across the board because of China, and the birth rates is just deflated. But e-commerce has grown by 40%, which is quite strong. So overall, look quite strong. I'm not an investor in Nestle, but they keep, I don't know, they're starting to draw me in a little. I'm starting to pay a little bit more attention to them. It's just a great company, I think, and their brand power is amazing. So I'm getting definitely more interested in them.
Yeah. So for me, Nestle is the top number one in the how you say it, in my European Noble 30, right? So
Yeah.
I'm not too big of a fan, but when I see these numbers, if they do it another 2-3 quarters, I might become a fan, because these numbers are really looking good for such a large company. It's the largest such a consumer staple in the world. So to hit such numbers based on coffee mainly, it's like extraordinary. So let's see the upcoming 2-3 quarters. I find it, and this maybe also in general for all the listeners, it's really hard to compare year-over-year numbers at the moment, because COVID-19 started to impact last year, mainly in March. So you still had the positive part of January and February. So it's really hard like for like.
Yeah.
But if that's the case, then this is even better for Nestle, right? If they show such a growth now.
I'm not surprised with the coffee, because I mean, a lot of people drink lots of coffee, and I had a coffee shop pre-COVID, and it's predicted to reach, I can't remember the figure, 6 or 7 billion worldwide, and grow at an exponential rate. Lots and lots of people drink coffee. Coffee shops closed down. People did not want to stop drinking coffee, so they go out and buy these brands. They buy Starbucks and bring it home. So I'm completely not surprised by this. We might actually see that drop a little bit when coffee shops open, when people start going out to get their flat whites or their macchiatos. But I'm not surprised by the growth on that. But I mean, it's still very strong.
Good numbers.
Great.
And then we can go to Coca-Cola, right? To stay in the consumer staple section.
Yeah, this is for my Spanish friends. I know I sold them recently, so I'm interested to keep following them and see how they're doing. I know Eli Snowball, for example, is really bullish on them, and we had a little debate going, but it's encouraging. They're still not back to the levels before COVID, although we are starting to see, I know revenues grew by 5%, but some of that was got to do with pricing. The coffee, actually, inverse to Nestle, their coffee sales declined by 21%. Interestingly, because Costa Coffee is closed, so that had a big impact. Though I think North America and Europe volume levels were still down, whereas in Asia the volume levels were up 9%. I know they track by volume levels, so it's not quite there, but it's certainly encouraging to see him return to some sort of growth. I believe March was their best month, and we should start to see that progress. So definitely staying on my radar, but I like to give them another year just to make sure that they they do return to growth and that they can continue with that.
Yeah, I find Coca-Cola is such a high margin actually business. So what I did the other day, I compared PepsiCo with Coca-Cola.
Yeah,
And we know Coca-Cola, Pepsi has also the whole, how you say it, Frito-Lay's business, snacks.
snacks. Yeah,
But what's really funny if you compare the absolute numbers, and I'm doing this now from my head, but I believe that the net income of Pepsi and Coca-Cola is quite comparable, but Pepsi has, I don't know, 2, 3 times more sales, more revenue. So what that shows you is like that Coca-Cola with way less revenue can earn much more money. And I think it is because Coca-Cola has spun off all these manufacturing, bottling plants and everything and such. But I found it really interesting. So Coca-Cola really intrigues me from that point of view. I mean, Costa Coffee is not really of my interest in Coca-Cola. They bought it, but it's such a small share of their revenue that it's hardly, let's say, meaningful for me. But there is something in Coca-Cola. I don't own them, but when I think about Eloy Snowball, there is something with this brand, right? That is so powerful and they're it's yeah, how they are able to produce this income. But to your point, the last decade has not been the decade of hyper growth or something like this for this company, rather for struggles, yeah, to find their
yeah,
mojo.
yeah. But to be fair, they were restructuring a lot of their bottling investments, and
Yeah.
that has only really played out the end of last year. The pandemic was probably the worst timing for them.
Yeah.
It was probably going to be the first year that to see how they performed once they restructured. So I believe, look, we'll start to see where they're at next year or the year after when we get a full year of proper sales behind to see how they actually do.
Yeah.
Okay, and let's move on to one of our favorite stocks on the show, Danone.
Yeah. So what for me was most interested actually was not so much the numbers, but it was the first time the two new co-CEOs reported. Yeah, because they fired our friend, and they have now these co-CEOs, and there was not much news there. Just that Emmanuel Faber, the former CEO, and the two people that he appointed are put in the waiting room. They're waiting for the new CEO, so I found that interesting. And they're still following the strategy that they started of localization and such. So from that point of view, they didn't really make changes. And then they are just waiting for the CEO. So the company is just in waiting mode. If we then look at the numbers, there was a brief decline of 3.3% compared to last year. I mean, no surprises for me. I'm still wondering, like, why did they cut the dividend with 8%? Yeah, so that's still this taste that I have. I think one of the things that you mentioned earlier, the nutrition, the milk powder and such
Yeah.
to China, that is really in decline, and that's really interesting to read that. Actually, I wasn't fully aware of the fact that it's so huge, hitting companies, but there's also been a boon to many companies in the past, the growth of China demand, right?
Yeah.
So it's now seemingly hyperbolically crashing or something like that. Yeah.
It's interesting you mentioned that there was a decrease, but you have to remember Q1 last year, at this time last year, a lot of people were panic buying, and
Yeah.
that had a positive impact on Danone at the time. But
Yeah.
that means that their comparability this year is at a higher basis than what it should be. So even though there
True.
is a decline, it's not really a decline by normal year standards. So I wouldn't pay too much attention
Yeah.
to that. The water segment is struggling, we know that, but we have seen a sequential improvement on
Increase.
that
Yeah.
every single quarter. So there's
Yeah.
definitely improvements there, and I have
They
no
are
concerns.
betting on the second half year because they are betting on the fact that I think they wrote it that at a certain moment in the summer they expect that the vaccination progresses so far
Yeah.
in the Western world that we should start thinking about that restaurants will start reopening again, and that's where they really get their revenue from with the water business.
Yeah.
So for me, this is still like, if it's not a dividend growth company, still value play for me. So I didn't sell the stocks. I'm not intending to sell them. I'm more waiting for the new CEO to understand how committed to this person is to the dividend, because the dividend is still good, right? From that point of view, and it's on a low valuation for me, don't know, when you think about it. So
yeah, the dividend is at the same price as 2019, so it's not
yeah,
it's nothing drastic. We mentioned some struggles in China with the infant nutrition, but they recognize that and they've changed tact a little bit, and they've started to hit on this adult nutrition, which is starting to really take off. So, I mean, I'm really happy, like you. I'm confident with them. I think they will keep their dividend and may start raising it again, but they're definitely a value play for us.
Yeah. Shall we do our good old Intel, Pat Gelsinger? How was his first quarter?
I mean, there was a lot of euphoria, wasn't there? We spoke about it when they had their investor day, and I mentioned that I sold my shares at the time because I just felt like they reached the peak, and we have good news, but nothing really happened or changed, or and you see this in this report. They're still talking about that investor day and what's going to happen, but you look at the numbers and they are what we expected. Revenue's down, gross margin is down, net income is down, earnings is down. So the only good thing I can say is that they're a cash-rich company. They generate 5.5 billion in cash, paid out 1.4 billion in dividends, which is what 25% payout ratio. I mean, but other than that, we covered quite a bit on it before. So nothing spectacular, exactly what I expected, and I have my buy order in at $50. So buy back my shares I sold at 66, I think.
Yeah, it's just a business in decline, and the question is if Pat can turn it around on time as per his commitments and promises. So I think what he did with this investor day is that he bought time for the company, because he has a really good strategy, I would say. And then these numbers are rather confirming what everyone expected already. But then still interesting to see that the stock is still declining. So I wonder, like, who didn't see this coming then, right?
Yeah, but I mean, a lot of investors do the opposite. They buy the news instead of selling the news, and they just get caught up in the moment. But I mean, like the PC unit, for example, the volumes are up 38% because of lockdowns, because people are working from home. But it's not going to stay at that level. This time next year, that will drop. And people have to see this. You have to see that this is going to come. So it's a turnaround story. It's a long-term project. So for me, it's certainly going to drop before it goes back up.
Right. Okay, so what we could do then maybe is look a little bit in L'Oreal, and I mean, again, what you said about European stocks, they only usually publish sales numbers, no balance sheets or anything. But I was so impressed with this 10% up, like for like. I mean, so the lipstick part of the divisions, what I understood, is still down. I can imagine that, because we're not all in the mega shopping malls trying out the new colors. But Asia growing, Asia Pacific with 24%, and China with 38%. These are numbers, these are cloud growth numbers from Microsoft and such. Yeah, we're talking here about beauty products.
Yeah.
This, if you think about it, right, the magnitude of their growth, it should be valued like a tech stock, and it is.
It is,
Yeah,
and
it
for
is.
good reason. For good, I was impressed with their e-commerce. I mean, nearly 50% growth is incredible.
Yeah, exactly, and they've been able to really switch that. So for me, this is really an impressive company. It's so bloody expensive, and yeah, I mean,
you compared it to Microsoft, and it's a good comparison for me, because remember when I bought Microsoft, and I was hesitant because I wanted to buy them at 180. They were hovering around 200, and I bought I can't remember, 10, 12 shares, and now they're up at 260, and I feel like I should have bought more. And L'Oreal is the exact same type of company for me, and it's really bugs me because I want to buy them, and I just
Yeah.
can't find the right opportunity to buy them. And if they
Yeah.
keep posting numbers like this, I'll never have that opportunity.
That's the thing, right? I think I should one time just do a discounted cash flow analysis on the company, and I'm actually doing it because I'm writing a post about it. And but I haven't done that part yet because what I do when I analyze a stock, I start with the business before starting to look at the numbers. Yeah,
Mm,
because I don't want to be biased by the numbers that I see. I want to form an opinion about the business first. So once I have that, maybe I just look at it from an I said evaluation point of view more than from a dividend point of view.
yeah,
Yeah, but this is such a company that even if it's just one share, I mean, it just needs to be in my portfolio. Such a company. Yeah, it's more like an how you say it? It's more like declaring your love to such a company.
yeah.
Yeah, just even if it's just one share. Like,
We spoke with Decline Capitalist last night, and he
yeah,
mentioned that this was one of his crown jewels,
yeah.
and then mentioned he had none in his portfolio, which was quite funny. But he has the same problem. It just seems he knows
Yeah,
that they are like the cream of the crop, but it's just so hard to buy them.
yeah. Well, shall we change our moods a little bit and start talking about IBM?
Should we put in a little disclaimer here that this might be a rant or two? I mean, look. I'll start
Yeah,
off with IBM, and if you look at their numbers, and we're going to look at it from a novel investor that just reads the figures as they are without going deep into the financial statements. So if you look at the revenue, it's up 1%. Looks good. The cloud and cognitive software is up 4%. Total cloud revenue is up 6.5%. These are all positive, and these are what investors are looking for. They want to see this cloud revenue go up because Red Hat falls under this umbrella. Red Hat again, revenue up 17%. So looking at it,
yeah.
it
Because
all
four
looks positive.
percent in cloud is nothing to write home about. Four
Hmm.
percent in cloud, but 70% in cloud. Those are the head numbers that you want to give as a company, right? To
Yeah,
for the Wall Street people and such, and to make them excited.
of course. And they
Yeah.
mentioned they've reduced debt by 5.1 billion since the end of 2020. It looks good on the face of it. Now I know you dug a little bit deeper into it, so maybe you
Yeah,
might.
because this is dividend talk, right?
Yeah,
We want to be intelligent investors. We want to be smart investors. And what we did, we took the Red Hat 2019 report,
yeah,
and we saw that they, what was it? They were a few, I don't, 5 billion in, I think
yeah.
5 billion in
Just
revenue in
under
sales.
5 billion. Yeah,
Red Hat, and IBM is not transparent about the numbers of Red Hat, so they're using the 70% without giving context.
yeah,
So we did something like over the 2019 numbers, 20% growth and 70% growth. If you do that, you come to 6.3 billion or something like that on a total of 23 billion annual. What is it? Cloud and cognitive software. So in the end, we notice if you then look at the total sales of the company and such, and total also the total income of the company, it's still less than 10% Red
yeah,
Hat as a total. So when you think about it, it's nice that they are growing 70%, but 70% of 10% is not so much in the grand scheme of things. And this is what I think you wanted to call out, that if you look at the headlines, you think like, wow, this company is really rocking it. But no, 4% in cloud and cognitive software. If you compare this to Microsoft, Amazon, and even SAP this quarter, is just not good. And please don't be distracted by Red Hat. I know Red Hat has brilliant solutions, really good solutions, but in the grand scheme of things of IBM, it's not having really an impact. Maybe in 5 to 10 years from now, but not today. And then where it becomes really annoying with this company is when you start looking at the earnings. Yeah, and then when you look at, I said the earnings, they're reporting a non-GAAP earnings of 1.77, but you need to know that their GAAP earnings are 1.6. It's again a gap of 71%, and their GAAP and non-GAAP earnings are every year growing. And I don't have the numbers here, but the other day I did this whole calculation in one of our earlier shows when we talked about companies in decline.
Yep.
It's a really huge gap. And why are these things? They are how you say it, acquisition related adjustments is already 40 cents. Yeah, and it is mainly, I said, due to depreciation and amortization and these kinds of things on also on past purchases and everything, past acquisitions, and all these kinds of things, right? They are keeping out of the numbers. But again, a one-off I can imagine, but this is a continuous thing. So what they're continuously saying is we overpaid for our past assets, or we overestimate our past assets, and we need to return those decisions, and therefore we need to, our income is less. The same is again with retirement related adjustments, 31 cents, and this is like IBM, just pay your bloody employees properly that are in retirement, and these are just expenses that should be on the income statement, and it's a continuous thing again, right?
Yeah.
So they're really cooking the books from my point of view. And what I also wanted to call out, they haven't, it's funny, they even have an adjusted free cash flow. What is cash flow about? It's to give as clean as possible your cash numbers.
I've never heard of that before, and I know we've said on previous shows we focus on cash flow when it comes to payout ratio because you can adjust earnings, and I've never seen a company adjust free cash flow. I mean, how do you adjust free cash flow? And I asked you that question beforehand. How do you actually adjust free cash flow? I can't understand that.
Yeah, what they're adding some expenses, cash expense back again that they believe is a one-off. Yeah. What I think is just important to know, their last, I don't have it open up at the moment, but I believe last year around this time they had a free cash flow of 1.3 billion, and the dividends are 1.4 billion. This quarter they had a free cash flow of 1.5 billion, and the dividends are still 1.4 and something. So their dividends are hardly covered from a cash flow point of view. The balance sheet was also shrinking because they paid off debt, but they did that with their cash. So also from that point of view, the balance sheet is shrinking, the total assets are shrinking. This is not good, yeah, because if you start thinking about book value and such as a multiple for valuation, it's all in decline. So for me, I don't understand the excitement. The share price went up 5 to 6% this week. I think it's due to the headlines. Company is just declining, and I don't know what it is. I don't know why people are happy.
I suppose the key takeaway we want to try and get across is that the headlines look good, but they don't give real figures for the likes of Red Hat. And if you dig a little deeper, there's a lot of stuff happening under. So don't get sucked in by the headlines. Make sure you understand what's going on, and see if you're happy with it.
Yeah,
I mean,
I totally get it when people say that yield is attractive. I count on the turnaround play. Looking at the spin-off, there might be a lot of value creation there. I fully get that. But my only ask is please read it, that you feel comfortable with those numbers, because they are really not, the headlines are manipulative, in my opinion.
okay, we'll move on while you're still in a good mood. Our last company, I believe, is Kimberly Clark.
Yeah, and Kimberly Clark is a really interesting company. I had it on my watch list, I think, in March. I also did a tweet out. So what's good to know, full disclosure, I own some shares in Kimberly Clark, but my fair value estimation is $117. It's trading around $132 today, I believe, and it had a decline of, 7%, something like that today. And what is really interesting, when I calculated my present value of the company, I didn't use the guidance of the company because I found it was a too big gap between the numbers of 2020 and their forecast. I couldn't connect it. It was too big. And I put even in my own calculations when I was calculating the forward price to earnings. I put that next year they will earn 7.30 $30. And the really interesting fact is that they have lowered their bottom line EPS forecast from 7.75 to 7.430 after this quarter. So I don't want to I said put myself a tap on my shoulder, but it it is so interesting for me that I felt it was conservative. No, that I needed to be more conservative, and I couldn't tell you. It just didn't make sense. So it was also a bit of gut feel.
Hmm.
But it's really interesting to see this now. It's really funny, and maybe also to explain the reason here. The reason why this is going down effectively is that the comparisons. So what they're saying now, comparison to last year when everyone was piling up with toilet paper and such, they produce a lot of toilet paper. I said it makes it hard to compare. What they
Yeah.
also say is input costs, commodity inflation, and we know that how is it? How you call it? Lumber or wood has
Yeah.
been
Lumber.
increasing like 2-3-fold over the last year, right? These prices, commodity prices, have been booming, and this really what is interesting. So their cost and their operational working capital is growing with this. So and that exists out of inventories and such and input costs, but they have not been able to pass it on to the customer yet. And this is really interesting because moat is usually of a company, when we talk company as a white moat, is described by brand power and such, and hard to disrupt by others, but also pricing power. And someone said today on Twitter, like for their key brands, they can probably pass on the prices, but they have a lot of white labeling. And yeah, it's really hard for such kind of brands, white label brands, to pass on the costs. And I think we will start to see this more, right? Said Coca-Cola was really clear. We
Yeah.
will pass on the cost directly to the consumer. Kimberly Clark has been struggling with it in quarter one. We need to see what it does in quarter two, if they are then able to do it. But I think this is something we as investors need to start looking at now, the impact of inflation to companies' earnings. Because if the inflation starts growing, they cannot pass on the cost, but it also will later. And I know there's not a direct relation between inflation and interest rate like such, but there might be a little bit of a causality effect. Then this could be a double-edged sword, right, for a company like Kimberly Clark.
Yeah.
So yeah, so I think it's overvalued. I hope it drops to 110 or so, and I might buy some more. But at the moment, it's not for me a buy the dip story yet. It needs to come far more down.
Yeah. But again, like Danone, it's starting at a higher comparison
Yeah,
basis point
sure.
than last year. I mean, I know in Ireland, toilet paper sold out. You couldn't get it.
Yeah,
It was like
yeah.
gold over here. So I mean, it's unfair to judge it quarter over quarter and based on a year apart.
But that's why I do a discounted cash flow analysis. And what I'm saying, I was already using conservative numbers on that. Yeah, and the company is now giving the same numbers as what I used as my input parameters. So it just confirms to me that the company is like $15 overvalued.
can you pass on that crystal
That's
ball
cheap.
that that you're able
It's
to
not a
predict?
no. I'm also wrong often in my predictions. So this is rather luck, I would say.
Okay, cool. So that's it for this week on the earnings. I'm sure it'll be plenty more over the coming weeks. So we move on to our listener questions.
Yes, and yeah, Phil is of course the first one, and he is asking, is there any company where you would love to see a spin-off or a bigger merger acquisition in 2021?
I wish I seen this question a lot earlier because I'd like to give it a little bit more thought because it's a very, very good question. Immediately, Intel came to my mind, maybe with their foundry fabrication business. That seems like the perfect company maybe to do that. Other than that, I didn't really have, but it would kind of make sense for me for that to split. I mean, they could have two really good businesses. They could expand. I know they're trying to sell off bits, but they could expand that really and really take over that market as well. So Intel is certainly one I would imagine that could do it. They probably won't. I know Intel like a little bit control over everything. They don't like outsiders coming in and all that kind of thing. So maybe they won't, but it's one company I could see it would make sense for them to do that.
Yeah. Yeah. So of course, like I will not go into it, but Tesla and Apple would be still nice to see with the Apple car and then Tesla. That would be like an awesome company, I think. But if I take it closer to home, sometimes I'm wondering like why doesn't Unilever just buy Danone? And the issue is that Unilever wants to is actually getting a lot more, getting rid of some of their food businesses. So it's a little bit anti-pattern to their strategy because they're focused more on beauty and personal care. I guess they want to be competitive more of L'Oreal and get a piece of that market as well. But if you think about the culture, their approach to society, it's such a nice match, Unilever and Danone. And I believe Danone could benefit from Unilever's scale. Yeah, and Unilever could benefit from the portfolio of Danone, and so I would actually be a fan of those two companies just merging.
Nice.
Well, will probably never happen, but yeah, that would be the bigger merger I would like to see.
Cool. Okay, so Centrino has asked us, his average price for Altria is $42, which he bought last October. Last week it reached $52. The yield has obviously decreased. Would you keep making dollar cost average monthly payments after such an upside, or temporarily pause buying, waiting for the price to drop back?
Yeah, that's actually for Centrino, that's a bit a contradictory question because why do we do dollar cost averaging? So that we avoid buying on the high everything or on the low, and because we cannot time the market. And what he's now actually asking is, should I time the market by temporarily pause my buying? So I would say if you really are convicted about this company, I would just keep dollar cost averaging. It's simple like that. Yeah.
Yeah, I mean, and they have dropped, haven't they, back a little bit as well after the recent news. So it's a hard. I get where he's coming from because I know you've spoke on it, and averaging up is
Yeah,
it's a hard concept for an investor. So it's easy to say we dollar cost average, but then when the price seems too expensive for us, we tend to stay away from it. So it is a hard. I understand what he's saying. It's a hard concept.
definitely.
I struggle with that as well. I really do. When I have a price for a company, I struggle to.
But that's why we make strategies, right? It's like stick to the plan,
Yeah,
and you're right. Psychology wise, it's really, really, really hard to stick to a plan like that. Yeah.
yeah, because we always know better, don't we?
Yeah, yeah. Well, yeah. Okay, next question is from Sheepstocks, and he is asking if Waterford, I think that's your hometown, will
Yes.
win the All Ireland. I guess it's about rugby, this
No,
one.
hurling.
No?
Hurling. It's our national sport, and I suppose he's asking me there if Waterford J had a public company and paid a dividend, would I consider buying it? So the first thing I will say, and only people of Waterford or maybe some in the hurling community will understand this, is of course I would, because I loves me county by. It's a reference that one of our best players at the time said, but I would obviously love Waterford to win in All Ireland. I've been to a couple of finals. They've lost them both. I don't know if it's going to happen in my lifetime, but I would love. And of course, if they had a public company, I would support them. I mean, I'm involved in GA here. I support them as much as I can anyway. So I would certainly buy that. So of course, I just can't see it happening.
Well, I hope they will win, just because it's you.
Thank you. What I do is I think I'll stay away from their games, and they might actually win. Okay, we move on to Tiago Diaz. And he asked us, do you think we will see tax advantage accounts like the Roth IRA and 401ks appear in Europe anytime soon? Or do you think that this pan-European pension product will remove the political will to implement such a solution?
Yeah, so this is really interesting because in Poland we have the equivalence of a Roth IRA and a 401k. So I don't believe it's in Netherlands, but I'm too long out of the Netherlands to really judge that. But in Poland we actually have this. So this year we started contributing to that, and we will max it out. But honestly, Thiago, I'm not such a fan of it. Yes, it's tax advantages, but I don't want to wait until I'm 65 or 60, I think, or 55 to withdraw from it because I want to live off dividends earlier. So this is more for me the dilemma. If I want to, yeah, if I want to retire in, let's say, several years from now, I need the cash then of the dividends. So I rather have to take the tax and just be most clever with the tax as I can. But locking up my money until then is not an option for me. So, and if we will put some, but if we withdraw, we will still need to pay tax over it. So it's kind of the benefits more for us to do it in this tax advantage account is that we can trade more at the moment without having really an impact. And
Yeah. I actually believe that this pan-European pension product will benefit us more in Ireland. It'll make us a little bit more competitive than what it is. So that actually is a benefit to us. We don't have any tax advantage accounts like the Roth IRA. I would personally love them over here, but we don't. So I know there's a lot of excitement's too strong of a word, but there's a lot of positivity around this pan-European pension products coming to Ireland. So it depends on where you are in Europe, I suppose.
Yeah. Okay, then we have the Celtic investor, and he is asking if he could only hold 3 stocks, 1 European, 1 US, and 1 from the rest of the world. What would it be and why?
Okay, Johnson & Johnson. I don't think I need to explain. They're just an absolute amazing company. I'd pick Diageo from Europe, European Dividend Aristocrat, really strong brand power, not going anywhere anytime soon. So quite happy with them. And from the rest of the world, it was quite tricky. I don't know if I'm cheating here because I've still gone with North America, but I've gone with a Canadian company, the Canadian National Railway. I mean, they're a monopoly over there, but they've been paying dividends since they've became public. I think grown at 18% per year. There's nobody going to be building railways anytime soon, so they're pretty safe in that end. So that's pretty much why I went with them.
So I would go with Microsoft, Unilever, or L'Oreal, but let's say Unilever and Alibaba. What's good to know, I'm not looking at current valuation here when answering this question. I'm just looking at if I would now put these stocks for 30 years in an account and I may not touch them, it would be those 3. Although with Alibaba, I would feel the least secure due to the geopolitical. But I wanted to take something from the Asia side, and then Alibaba for me is the most interesting one to choose.
Would Taiwan semiconductors make a little bit more sense from that side of the world?
I rather have I rather have a consumer staple. That's how I look at a company like Alibaba in 20 years from now than a company in the chip industry.
Yeah.
Okay, and then Taurus Invest, he's asking, do you utilize your capital gains tax allowance of, what is it, something more than €1,000 per year?
Yeah, 1270 every year. Of course I do. That's what it's there for. So I try to take advantage of it when I can. My tax accountant looks after that for me. So, but certainly, that's what it's there for.
Cool. So Tony has a similar question then compared to Celtic investor. Imagine you're allowed only to invest in one single stock. Which one of your portfolio would you choose?
Yeah, it would have been Johnson & Johnson or Microsoft.
Yeah, for me, Microsoft. Okay, forward dividends. What is the European reaction to Biden's capital gains tax plan? Do you think Americans are just spoiled?
Do you know what? They've been speaking about this in Ireland at some time as well, that maybe some of the middle class or lower middle class want to tax the rich and spread out. But why? Why should they? I mean, these guys have earned their money. Why should they have to pay for everyone else? I do think some Americans are spoiled, but I don't think that they should be punished necessarily for that.
Yeah. I think it's for people that have more than 1 million, right?
Yeah, but the money is irrelevant. I mean, they obviously work hard for the money, or they might invest the money. Like,
yeah, no, I'm with you.
they take all the risk.
Yeah.
They have businesses, or they're investors. They're taking on the risk, and there's people out there not willing. Not. I don't want to normalize people or put people in a bracket, but there are people out there that want to live off benefits and think that it's okay to tax the rich who are taking all the risk and give them money. And I don't
Yeah.
believe that's the case. They have their money. They've earned it in whatever way they have. They deserve to keep it.
What I generally would like to see is that there's a more equal level playing field when it comes to paying tax. Yeah, not that someone like Trump ends up on zero tax a few years in a row.
Yeah.
Yeah, then there's no contribution. But for me, yeah, no, I don't think from that point of view that Americans are spoiled. They are spoiled because they have all these nice dividend aristocrats. That's why they are spoiled. Yeah. Yeah, I think America has bigger problems than the capital gain tax, and I hope those people stop being only seeing blue or red and start just talking.
Yeah.
Actually, not even talking, but just start listening to each other. I think that would be the best for America at this moment.
I suppose on the flip side, and to contradict everything I have said, the gap between the rich and the poor seems to be getting so much bigger. So how do they control that? I don't know if tax is the right way to control that. Like you said, maybe a more inclusive way of everyone
That's what I
paying
think.
tax or something. But I don't think tax is the way to go. But certainly education or something should be provided to try and level that playing field a little bit. But I mean, that's for a different discussion, I think.
Yeah. Okay. I think this is the end of the show.
Wow, that went kind of quick.
Yeah.
So yeah, no more questions. Awesome. So again, thank you. You spent a lot of time going through them reports, and particularly with IBM, I appreciate that, because some stuff there I would not look at myself. I would just look at the headlines. So I do appreciate you going through that. And with AT&T, I believe looking at the Ebitda is probably a good tip for companies like that. So it's great to have your knowledge here, and thanks for that. Thanks for your time.
Likewise, EMF. I so much enjoy these shows. It's already, what was it, number 45? We will be soon, in few shows, we will be reaching the 1 year. That we should celebrate that.
Yeah, we definitely should. And again, to all our listeners, thanks a million for all. I don't know about you, I'm getting loads and loads of emails lately. Joining us on Dividend Day and reaching out to us on Twitter. It's I mean, it's been such a journey, but thanks a million for listening to us and joining us. Next week we will have Russ. We recorded that last week actually, from Dapper Dividends. So stay tuned for that, and we will see you all soon.